Two numbers hit their lowest levels in a full year on the same day, and at first glance, they seem to be telling the same story, but they aren't. In fact, they're pointing in opposite directions, and understanding that difference is where the real insight lies. On one side, the paper price of silver dropped sharply, touching an intraday low not seen in months. It fell fast, over 4% in a single session, and anyone watching a chart would immediately interpret that as weakness. Price down, sentiment down, trend under pressure. That's the surface level conclusion, and it's the one most people stop at. But beneath that price action, something else happened, something that doesn't show up on a chart. The total physical inventory sitting in major vault systems fell to its lowest level in 12 months. Not only that, but it's been declining steadily for a year. A massive portion of the available silver has already been removed, and the pace of that removal hasn't slowed. So now you have two lows occurring simultaneously, a short-term price low driven by selling pressure and a long-term inventory low driven by persistent physical demand. Same market, same day, but completely different forces at work. Most people see the price drop and assume it reflects weakening fundamentals. But price, especially in the short term, is not a pure reflection of supply and demand. It's often a reflection of liquidity needs. When leveraged participants need cash, they sell what they can sell quickly. Silver, especially in ETF or futures form, is highly liquid. That makes it an easy target when margin calls hit. This kind of selling doesn't mean investors suddenly believe silver is worth less. It means they need cash immediately, and silver happens to be something they can convert into cash without delay. That distinction matters because it changes how you interpret the move. When multiple asset classes fall at the same time, stocks, bonds, metals, it's usually not about a change in fundamentals. It's about stress in the system. Something is forcing participants to unwind positions across the board. It's not selective, it's mechanical. That's what a multi-asset sell-off represents. Not a shift in long-term value, but a short-term scramble for liquidity. And while that scramble is happening in the paper market, the physical market is doing something entirely different. Industrial demand for silver doesn't stop because the price drops. Manufacturers don't halt production lines because futures contracts are down 4%. Their supply chains operate on schedules set months or years in advance. The silver being used in electronics, solar panels, medical devices, and industrial processes is still being consumed at the same pace. That demand doesn't react to daily price fluctuations. It reflects long-term planning and real-world usage. So while traders are selling paper silver to meet financial obligations, physical users are continuing to draw down inventory. That's how you end up with this divergence, falling prices alongside shrinking supply. Over the past year, the total amount of silver held in vault systems has dropped dramatically. A significant percentage of what was there has already been removed. This isn't a one-day anomaly, it's a sustained trend. And more recently, the pace of that decline has accelerated. In just a single month, tens of millions of ounces have left the system. If that rate were to continue, it would imply a complete turnover of remaining inventory within a relatively short time frame. At the same time, the amount of silver actually available for delivery, the portion that can satisfy futures contracts, has become increasingly limited. That creates a growing imbalance between paper claims and physical supply. The ratio between outstanding paper contracts and available physical silver has climbed to levels that raise important questions. The system works as long as most participants don't demand delivery. Historically, they don't. They roll contracts forward or settle in cash. But that behavior is an assumption, not a guarantee. If even a modest percentage of participants decided to take delivery instead of rolling over, the available inventory could be quickly overwhelmed. It wouldn't require a majority, just a shift in behavior. This is where the structure becomes fragile. The system relies on confidence and routine. It assumes that participants will continue to behave as they always have. But when conditions change, behavior can change with them. There's precedent for this kind of stress. In the past, when physical demand threatened to overwhelm available supply, rules were changed to prevent the system from breaking. That's not speculation, it's historical fact. The question now isn't whether the system can function under normal conditions, it's whether it can handle a shift in behavior under stress. And while that structural tension builds, the macro environment adds another layer of pressure. The financial system as a whole is dealing with the consequences of years of low interest rates. Leverage was built on the assumption that borrowing costs would remain low. Now that rates have risen, that assumption is being challenged. As yields increase, the cost of maintaining leveraged positions rises. At some point, the math no longer works. Positions that once generated strong returns become unsustainable. That's when liquidation begins. And when it begins, it doesn't happen in isolation. It spreads across asset classes because the same participants are often involved in multiple markets. They sell what they can, not necessarily what they want to. That's why metals can fall alongside equities and bonds. It's not about fundamentals, it's about liquidity. But here's the key distinction. The forces driving the sell-off are temporary. The forces driving the physical demand are structural. Leverage cycles come and go. Margin calls get resolved, positions get reset. But industrial demand, supply constraints, and long-term monetary trends operate on a different timeline. That's why the divergence matters. Because once the liquidation phase passes, the underlying conditions haven't disappeared. If anything, they've intensified. The financial system still carries a massive amount of debt. The cost of servicing that debt is rising. At some point, policy responses become unavoidable. Historically, when financial stress reaches a certain level, central banks intervene. They lower rates, inject liquidity, and expand the money supply. The goal is to stabilize the system, but those actions have consequences. Increasing the money supply affects the value of currency. It changes how assets are priced. In past cycles, this kind of intervention has benefited real assets, particularly those that can't be easily expanded in supply. Precious metals fall into that category. There's a historical pattern where metals decline during the initial phase of a crisis, when liquidity is being raised, and then recover strongly once monetary expansion begins. The decline is driven by necessity. The recovery is driven by policy. What makes the current situation different is the condition of the physical market. In previous cycles, supply constraints weren't as tight. The system had more buffer. Now, that buffer appears to be shrinking. At the same time, broader economic shifts are adding to the pressure. Supply chains are being disrupted. Key inputs for industrial production are facing constraints. Energy markets are volatile, and those effects ripple through multiple sectors. Silver, as an industrial metal, sits at the intersection of these forces. It's not just a financial asset, it's a critical component in modern manufacturing. That dual role makes it particularly sensitive to both financial and physical dynamics. When financial stress forces selling, the price can drop quickly. But when physical demand continues and supply tightens, that creates a different kind of pressure, one that builds over time. And eventually, those pressures have to reconcile. The market can't indefinitely price an asset as abundant if the underlying supply is shrinking. At some point, the physical reality asserts itself. The timing of that shift is always uncertain. Markets can remain disconnected from fundamentals longer than expected. But the longer the divergence persists, the more significant the eventual adjustment tends to be. Another layer to consider is how different assets are performing relative to each other. Gold and silver, for example, don't always move in lockstep. Their ratio can widen or narrow depending on conditions. When silver underperforms gold, it often reflects its dual role as both a monetary and industrial metal. During periods of stress, silver can be hit harder because it's more volatile and more tied to economic activity. But that underperformance can also create opportunities, especially if the underlying physical conditions are tightening rather than loosening. Meanwhile, parts of the financial sector are showing signs of strain, not always in ways that make headlines, but in underlying trends and relative performance. When financial institutions begin to weaken, it can signal deeper issues within the system, and when those issues become visible, the response is often swift and significant. That's when policy decisions come into play. Central banks face a difficult balancing act. They have to manage inflation, support economic growth, and maintain financial stability, all at the same time. When those objectives conflict, something has to give. In many cases, supporting the financial system takes priority. That can mean policies that increase liquidity, even if they carry longer-term risks. For assets like silver, those policies can be a major driver over time. But again, timing matters. In the short term, markets are reacting to immediate pressures. Liquidity needs, leverage unwinds, and risk reduction dominate the narrative. In the longer term, structural factors, supply constraints, industrial demand, monetary policy, take over. Right now, both timelines are active at once. The paper market is reacting to immediate stress. The physical market is reflecting longer-term trends, and the gap between them is growing. That gap doesn't resolve gradually. It resolves when one side can no longer ignore the other. Either physical supply increases significantly or pricing adjusts to reflect the constraint. And given the current trajectory, the latter becomes increasingly likely over time. So the question isn't just whether silver is up or down today. It's what the underlying signals are actually saying. Is the price decline a reflection of weakening demand? Or is it a symptom of financial stress? Is the inventory decline a temporary fluctuation? Or is it part of a sustained trend? When you separate those questions, the picture becomes clearer. The price is reacting to short-term forces. The inventory is reflecting long-term behavior. And those two things are not the same. Understanding that difference is what allows you to see beyond the chart. Because the chart shows you what just happened. The underlying data shows you what's been happening and what may come next. In markets, the most important signals are often the ones that don't align at first glance. They create tension, they raise questions, and they force you to look deeper. Right now, that tension is clear: a falling price alongside shrinking supply, a short-term sell-off within a long-term drawdown. Two numbers hitting lows at the same time, but telling completely different stories. One of those stories is temporary, the other is structural, and over time, structural forces tend to win.